Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, October 2nd, 2025. It is 10:55 a.m. Eastern Time as I'm starting the video. I'm going to start out with this one. I've covered this recently for you. Still waiting for and very, very much expecting and looking forward to the great margin unwind, is what I'll call it. This is the FINRA margin debt chart. So, what you're looking at is this is margin debt out to if you have a brokerage account, margin account through your broker, what it does, it allows you to buy. You give them 100,000, they'll let you buy 400,000 in stocks, or they'll let you hang yourself with enough margin on futures, which are more highly leveraged options, of course, and all that. So, and it's just a very almost immutable, really, for lack of a better word, cycle. In bull markets, think back in the roaring 90s, the dot-com bubble margin increased. You can see the red line's the S&P 500, and then the blue here is these blue bars are the margin. So you can see you always get at the top this kind of final surge up where you have a steady increase, and a lot like somebody asked the question recently, what does a blow off top or a buying climax look like in a market, in the stock market? And you get the same thing with margins. So it's very simple, and the human psychology is very predictable. The masses, and so you have bear markets. If you look closely here, these shaded areas, there's a shaded area, another shaded area, they mark recessions. And recessions used to come on average. I mean, I'm going to date myself. I was in college in the early 90s. And late 80s, early 90s. And back then, it was pretty typical. We had about every 5 years or so, you had a recession. It's a natural part of the business cycle. Really no different from the seasons, that we have. Spring follows winter, summer follows spring, and fall follows summer. And it's those just sometimes they start earlier than others. That's why they have that old Groundhog Day thing. If Puxahani Phil sees his shadow, there's 6 more weeks of winter, that kind of thing. So sometimes the business cycle is a little longer, sometimes a little shorter, but something unique happened or different happened back in the financial crisis. It kind of started back here, but the financial crisis is where it really began, where the Federal Reserve figured, you know what, we're omnipotent. We can prevent all future recessions and just really cancel out the business cycle. So why not have a permanent spring, make everything great? And that's what they did. And they did that by excessive easy money policies, excessively and artificially low interest rates. And they were able to do so because that horrible monster that we know of called inflation hadn't reared its ugly head really since the 70s, decades earlier. And so during the financial crisis, the markets were, we did have a massive bear market. They called it the Great Recession, a big recession. But then they threw everything at it, free money, near zero rates, and then quantitative easing to further juice liquidity into the financial system. And they figured, guess what? I and a lot of others thought that was going to be inflationary, but this whole period, inflation never reared its ugly head. There's a financial crisis right here, 2007 to 2009. And so they kept doing it. And then when COVID hit, they just figured, you know what? Fuck it. Let's just go all in, and we'll just print insane amounts of money. And Washington also, with the Fed and all the central banks taking rates to zero or even negative overseas, negative rates, and then just injecting massive amounts of liquidity via quantitative easing. They did it, but guess what happened? We all know that what happened from there is inflation didn't just start spiking up, it surged to its highest level in nearly half a century. So the rest is history. Now we know that this is the balance right now, is that, and as I've showed you many times over, if you're new to the site, I'm not going to get into this right now, but bonds have, by every single metric, ended a secular bear market, a nearly 50-year-old bear market. With falling interest rates, and that came down pretty much to the bottom. And by every metric that I have, and I've showed you for years now, we've entered a new secular bull market. We're in the infancy of that, most likely in rising rates and an inflationary environment. So where all that goes is sooner or later, they're not going to be able to deploy the aggressive stimulus, monetary and fiscal. Fiscal will blow up the budget. That budget. That's what comes. We're already seeing the bond vigilantes step in here with the last rate cutting cycle and so far this one. So Washington's only going to be able to do so much stimulus, or our Treasury bond markets can implode. And then the Fed can only do so much, or guess what? Start getting too easy, too fast. Inflation's likely to have the next leg up. Okay, so where am I going with this? This is again, just look at the blue line. You can see in a normal bull market, this is the S&P in red here. Market's going up. And, as it goes up, more and more people feel it's safe to step back into the water. I'm talking about after the last bear market, last recession. And so more and more people come in. They start finally figuring, okay, it's safe to get back in the water. The market's been going up now for a year, 2 years, 3 years. They start increasing or starting to add back to equities in their 401k, or they increase their equity holdings. And then they start towards the end. Almost every bull market ends the same way. There no two tops are exactly the same, but you have that more and more excessive risk taking, and then people tend to say, you know what? My Apple, my Amazon, my Nvidia has been doing so well. I'm doing really good. Why don't I borrow on leverage? My account's now up. I put 100,000. I've got now 300,000. But I can buy $500,000, $600,000, $800,000 or $700,000 of stock. Why don't I do that? Why don't I grab a little Bitcoin over here? And so that's what you see. And then at the end, it just has that kind of parabolic surge, and it's ultimately a kiss of death, and it's followed by the masses. This is why you see that surge of margin interest. They, again, for that logic, I'm saying, hey, my account's doing so well. Why don't I borrow and juice it up on leverage? And that's what happens. And then you get the great leverage unwind. And that's why. So if you've ever wondered why and how these bear markets are so powerful when you get the real bear markets, not just a correction. The NASDAQ fell 78% back after the 2000.com bubble burst. 78%. Both the NASDAQ 100 and the S&P 500 fell over 55% in the financial crisis. And again, you can see the signatures here, and this is COVID here. Margin debt was getting pretty healthy because, look, we were in a long, steady era. That was that Goldilocks period of virtually no inflation, and the Fed kept the easy money pedal to the metal. And then, of course, you had COVID. And then that's where they hit the all-out nuclear button, what I call Ursa interruptus. The charts had priced in a much bigger and prolonged bear market. But again, if you have, which they did, if you throw enough money at anything, including the global financial, stock market and the economy, you're going to get, the results that you intended. And then so we did. We juiced it up. Margin debt surged. And then what happened? We had that bear market back in 2022. Again, you can see the surge up there. Where are we today? Well, it started growing. It approached the levels recently where it was back then. And we had that nice, very profitable to trade on the short side correction at the beginning of this year, which we did. Got out with impunity there at the bottom. And then what's happened since? You have almost a parabolic surge up there, both in the markets and margin interest. Now, if you think for a split second that there's it's mere coincidence. Let me see if I can go back here, show you that. I've got to go back to this chart. Where did it go? Okay. We'll go back to 2 years. You can see here, I think you can see, I have to put my crosshairs on them, these bars. So it shows you that margin has surged commensurately with the surge in the stock market. Okay, bear with me here. So by that logic, it's safe to assume that a lot of the gains have been but borrowed money. And what happens when the stock market reverses? Inevitably, and I think even the most bullish bull will realize there's going to be corrections, right? And sooner or later, some people believe, like the Fed does, that they banned the business cycle, meaning the periods of economic expansions followed by recessions and contractions. Of course, I think they're just creating a bigger, much bigger, it's like I've used the analogy of the Forest Service, doing the prescribed burns, burning down the undergrowth. So when you do get those fires, whether it's, campfire that starts it or a lightning strike, you don't burn down the entire forest, the 100-year plus trees and everything. And that's exactly what the Fed is setting up for. And that's why I have such aggressive longer term targets. That's fundamental analysis, but it also meshes with the charts. So, all I can tell you, and this is not that my outlook on where things might go and how bad the next real bear market will be. Again, that is subjective, and I'll either be right or wrong. But I'm certainly going to trade the charts as they come. Remember, I think a lot of people get hung up on that, and just having a longer term bearish outlook on the economy. Looking out 5-10 years has nothing to do with where anything's going to go today, tomorrow, next week. You know that I'm an equal opportunity short / long side trader, no matter what it is: commodities, equities, bonds, crypto, gold. That's it. I'm going to go where the 60-minute charts tell me to be, the daily charts, and then long term, I'll share my views. All right. So you can see again, when I hold these blue lines here, the commensurate surge that helps to support the case that a lot of this rally has been built on leverage. And we all know, at least most of us know, if you have a background in finance or somewhat understand, or even, in your house, or maybe a friend or family member or yourself that got in trouble with too much credit card debt, and then the unwinding can be powerful. We saw that was really the crux of the financial crisis with, home prices, moving up on. That's of course a leveraged item, everyone taking out mortgages. And then when things go the other way and your collateral then is a lot lower, that's where you had people that started walking away and defaulting on mortgages. So when the stock market, what happens is, the housing cycle takes longer to play out, and the stock market can happen pretty fast, because all you have to do is get that catalyst, and the catalyst is simply whatever the fundamental catalyst. I don't care. The markets, the media will always retrofit or find a headline to fit the cause of correction. But what happens is, just know that once prices go down, and it's not a singular level, there's multiple levels. Of the further prices go, selling tends to get more selling, and at some point stops get hit on longs. And you get to that point where if you drop enough, and I don't know where that magic number, I try to give it to you on my charts where I think things will break levels if we get taken out in the stock market, such as the 200 days or key support levels. But what I can guarantee you is there's a lot of leverage. We know that at record highs, margin debt in this market, and at some point in the future, that will get unwound, as it always has, and it usually does after these big surges like that. And when it does, again, it's a powerful, vicious cycle. And I tell you all this just because I know there's some that might look at my long-term targets on the market and some other stocks and things and say, you're just smoking something. You're crazy. There's no way NVIDIA is going to drop 50+%. There's no way that the NASDAQ 100 or the S&P is going to drop 50-something%. And my whole life I've studied charts, and it's just part of the cycle. And then usually the bigger the bubble to the upside, the bigger the ensuing mean reversion. And again, like I said, there's now a fundamental backdrop, and that is bonds. No, I don't hear, maybe others talk about this. I kind of live in my own bubble. But again, the supersized, the nearly half century of above average returns in the stock market were 110% attributed to the bear market and interest rates, falling interest rates. And now, what's questionable, am I right? Have we embarked on a new secular bull market in rates, rising interest rates? That only time will tell. At most, all we can do is stay down at the bottom because we hit near zero, right? And so, at best case scenario, we stay low. But then there's not that added juice. I said I wouldn't do it, but I'm going to, because I lie all the time in these videos. Tell you it'll be short and then it's long. This is what I'm talking about. This is the 30-year bond yield. 10-year looks the same. We peaked back in the early 80s. This is that secular bear market in interest rates, falling rates, which again, talk to anybody who has a background in economics or finance, especially the financial markets, and they say this is an immutable fact that falling rates It's bullish for the stock market for two reasons. It lowers the cost of capital, which spurs economic growth. That's a very simple concept I think anybody can follow. It's a whole lot easier to buy that Ferrari you want if you can get a 4% loan from the dealership versus a 15% loan on the car. Same thing with a house, right? Or start your own business. Very easy when you can get a 3, 4, 5, 6% loan versus a 15%. So that's a very simple concept that hopefully all can understand. It's also juices the company's profitability. And the other thing is, back here, guys, you could get, and this is when I started out in the business. I didn't start back then. Started back, there's a stockbroker from Merrill Lynch here in the mid 90s. And I saw these bonds coming in. I saw these old ladies coming in with 15% treasury bills. I remember coming in, maturing. And I was like, wow. So here's my point. And so you need to understand it's a powerful concept, but it takes time to play out. Always has been a correlation between interest rates on safe money and the stock market. And even various Fed chair people, I remember Bernanke had stated it outright, and others, they intentionally lowered rates during the financial crisis back here in 08 and at other periods to force money into the stock market, to support the stock market. Because when rates go down, there are a lot of people, and even Granny Smith she's happy with her 15%. She's even happy with her 7% CDs and treasuries. But guess what? She's not happy when she walks into the bank and they tell her that her CD is going to roll over at 0.75% if she locks her money up for 2 years, or 2%. And so it's a gradual but powerful force where money moves out of those safe harbor investments. Not just grandma, all right, or you or me or whoever has a part of their portfolio in fixed income. It's also very, very much institutions as well, insurance companies, pension funds, and all that. So when the alternatives suck, when fixed income rates are low, it drives money in the stock market. However, this is that downtrend. This has been broken by every metric I look at. In a best case scenario, I see maybe a pullback, abatement in yields in the next year or so, followed by, this is a new uptrend, I believe. And so that's, again, guys, don't get too tied up on my longer term outlook because it's going to take a while. But I'm starting this video and I'm going back to right here, just so you know, be ready. That's all I'm trying to say. Whatever sport you play, or if you're in the markets, especially, consider it like war. You need to be on standby and ready to move quickly to react to something. And those reactions are opportunities. And so this can continue. There's no way to say, when you look at the history, again, there's no way to say where it ends, where the top is on this. But we can kind of look at the patterns and see the surges, and you see the market start to go parabolic and sentiment get to extremes. That's usually where those bubbles pop. And again, the takeaway is, once it reverses, as it always has, and again, you can go back and study history, it's a powerful force, because selling again begets more selling. Because you may love NVIDIA. You may be the biggest friggin' AI bull out there, all your money in NVIDIA. Within your heart of hearts, the stock can only go up over time. There might be corrections, and you plan to hold it until they pry it out of your cold, dead hands, right? But guess what? You bought it on margin. You don't have a say in that. Your broker will give you that margin notice. You'll get a little pop-up on your phone now. It used to be my mail. When I was a broker, I had to call the clients and tell them, hey, you got a margin call. You got to give me some money within the next week or so here. And it was like that. Now everything's electronic. And so you get that margin call. In many cases, by the end of the day, you either decide what to sell or they're going to do it for you. And that's how margin calls work. They will blow you out. And then that's where you get the powerful drops. So enough on that. Let's talk levels now. Let's get into the stock market again. Every now and then I just like to digress and kind of go over the fundamental backdrop, because the relevance is how quick things can happen. All right, so here's that QQQ. Yesterday I told you I thought it was objective to short of the downtrend line, although I did say this is the highest probability, safest bet, waiting for a breakback below 596 or so right there, that recent support level. This was our short entry, and as I drew out, Any new high would be a marginal new and still very, very much divergent high. So all I do, just like when your favorite football team gets a first down, what do? They pick up the chains and they move it forward. So we still have that divergence. And as I often say, divergence is not a sell signal, it's a condition, but it is a condition that usually precedes trend reversals, be they negative divergence, which are bearish, or positive divergence, which are divergences, which are bullish. And so that's it. And then you have this uptrend line I showed you now, nice and clean, well defined. And when that breaks, so these are your next objective short entries, a break of that, and then a break of that. And this is a level, like I said, will probably spark much bigger selling. All right, let's jump into, let's go to gold real quick. Definitely want to cover gold. Or you know what, I'll hit on natural gas because we hit that target today. T1, remember this was our breakout here. And we went sideways for a bit. And then yesterday I gave you an update, told you the next buy signal would come on a break of R2. We were at R2. There it was. You had plenty of opportunity this morning. And again, if you want futures, I'll give you, just ask upon request. Remember, we rolled, so the futures are different from when I first gave you the, we're on the, what are we on now? The November contract. So we would have been on the October contract back then. So all the levels keep changing on the futures. And from my experience, I don't get a lot of requests on the futures. I know most people trade ETFs and ETNs. So if you want the futures chart, I'll give it to you. Just ask in the comment section. All right, so that looks good. And of course, crude's falling, which helps. Crude and natural gas tend to move inversely from one another. And it's simple, again, has to do with when crude prices are very high. They've got all the wells turned on. They're pumping, gushing oil. Natural gas is a byproduct. It's coming out, so there's a surplus of natural gas. And when crude starts dropping, they start capping some of the wells, and you have a lower supply of natural gas. It's simple, very simple concept. So anyway, that's it. We also recently got into the red and orange zones, and even the yellow zone. And this is where I say it puts pressure on the stock market. We've seen corrections on these previous moves up into the orange zone before. And again, the market's almost ignoring everything right now. Fundamentals, it doesn't care about the shutdown. We even started the day down yesterday and then ended up rallying. Here, let's roll into kind of that. So, the shutdown, who knows? Maybe it'll be net bullish for the dollar. The current administration, say what you want about them, but Republicans tend to be more fiscally conservative. I don't think anybody's going to argue that the Biden administration was very, both spenders. Believe me, Trump's a big spender too, but he wants to spend on different things. Biden wanted to spend on social services, the welfare state, and green initiatives. However, this administration, Trump's trying to cut fat, especially where the federal government, and who knows, maybe that'll be bullish for the dollar. The market's trying to figure it out. I gave you my thoughts. We already hit that first target. I think we'll probably head up to here, but as I said, we need to break out. This is where I think you'll get that, what I call POR, point of recognition for gold bugs. If the dollar breaks out above that level, and starts to run up to my second target, that's where gold and silver will probably be in near crash mode, at least a strong correction if I'm correct. But I'm going to get to those in a second. Euro, US dollar, gave you this right here. This is the biggest component. 57.6% of the dollar index is the euro. So peaked with that divergent high. Then you broke down. You had a sell signal on the wedge break right there. But you also back tested the downtrend line, so we need to move down below there, and then that means the dollar goes up and gold will be falling. And then I gave you the setups today. I think it's time. GDX. This is a daily chart, bearish engulfing candle. We'll see if that proves to be a top, at least a near-term top. There's that 60-minute chart I gave you. I don't have to squint to see a breakdown from that 60-minute bearish rising wedge. And then we'll go to futures. So we can look at the ETFs. SLV, breakdown. GLD, right here, right now, close to it. This is it. You need to see gold break down. And then silver, GDX, they'll all follow it. So gold is right on the line. You can see this is the uptrend line I've given you there. Big fat bearish engulfing candle working out so far. And anywho, you have the targets. I gave you those trades. I gave you the futures. I like futures personally, but you can trade gold. There's leverage ETFs. Again, I can't name them. There's so many different inverse and leverage, non-leverage ETFs. You guys pick the one you want. I always chart the one-time non-leveraged when I'm tracking a commodity or something. Okay, regarding the stock market, as I've said many times, I think it's pretty well known that technology is by far the largest component of the S&P 500, and of course the Nasdaq 100, even more so than the Nasdaq. Second largest component of the S&P 500 are the financials, and of course the financials consists of different type financial companies, insurance companies, and all kinds of niche lenders. But the banks are the big ones. And this is just a global. These are global banks here, and you can see, this chart how I have these divergent highs. They're not labeled as such, but you can see my lines. These are negative divergences, and the corrections have followed: 13%, 21%, and now we have the most recent divergent high and a breakdown recently. Nice clean, especially today, breakdown there. You've got your leading banks like JP Morgan's got a little work to do to break down, but some of the others have already gone. Bank of America has given way. Wells Fargo broke down. RY, Royal Bank of Canada, I don't have the chart marked up right now for you, but you can see Citigroup. So quite a few breakdowns in that sector, and again, that will there's going to be little stops along the way. This is the first support level. We'll probably get a little bounce here, 50-day moving average. And then if that level breaks, we come on down to 88. And that'll be another additional from the drop we've already had, about 8.5%, 9% in Citigroup. So continue to watch the banks. We're already short the regionals, including one Fifth Third Bank. KRE already broke down, builds on the breakdown. I've covered this recently. We had a breakdown of the primary trend line there, back test, followed by a rejection with a break of the little wedge, break of the secondary primary trend line, moving lower. Fifth Third is just, an individual bank that we shorted here, somewhere there. It's now taken out S1. We need to see it take it out on a daily closing basis. We already had an intraday dip below S1. Parked on it yesterday, below it right now. There's still your first, second, and third targets for that one. Oh, I kind of got off on. I didn't. Did I? Yeah, I followed up on. Gold. The one thing I didn't follow up on is GDX. GDX. There's that 60-minute chart. I'm sorry, I did get GDX. I did cover that earlier. I just want to look at the big names. The big names need to break. Newmont, AEM. You can see all these little trend lines they're at. This one's a little, that should be about right there. That one's starting to crack. So these are your individual miners. And again, this is a trade with a tremendous amount of hot air. Look for these high-level bearish PPO crossovers. The PPO does a great job working as a trend indicator. If you put up a histogram, it'll show you, green means the PPO line's above its signal line. And then you're starting to get a cross right here. The last time you had a crossover was right here, if I take it up. And I'm going to cover that whole red period with this. And that's a double-digit drop. Doesn't look like a lot. It was another double-digit drop. Again, these are just nice trend indicators, and they can get you in pretty early or get you out, get you into a short out of a long. And so in this one, that is a very big green hill, like extended. These are what I call big green or red hills when the PPO is above the signal line. And so, typically the bigger the hill, typically the bigger the correction. Oh, finally, let me just keep this video short. Let's just go to the VIX. Or we can look at the proxy I gave you. You can use VIXY. R1 means first resistance. That's the trend line. Pop that. That's a buy signal. And then R2, second resistance level. And then you have some pretty aggressive targets, as I showed you here. This was from the previous trade. It were truncated here on April lows because for the reasons I stated. Time to cover all shorts and go full long. because for again multiple reasons, the time. So that kind of truncated that trade. Was to fade the VIX and go long the equity markets, and now we come full circle. If you're wondering why this is lower, so much lower than that these previous lows, like all ETFs, ETNs, they have expenses and fees roll over. You're going to lose money, especially in VIX tracking ETNs. You will lose money over time. It's a hit and run vehicle, and we've had a lot more hits, and we've caught all the big runs in this thing in the last couple of years. Had a couple objective entries I gave you here that didn't pan out, but again, that's what stops are for, and you got to see the sell signals in the market. Although this one, like I said, it's a standalone trade on itself. If these levels get taken out, R1, then R2, will most likely be because the stock market is breaking comparable support levels. So that's that. And then there's this VIX futures chart, nice wedge there, divergent low, on around long-term support. Remember, the spot VIX, as I showed you, is making a series of higher lows so far. But these are the last few setups. Again, we caught both of these. Not only caught them, we were in right before the breakout. I had such a high degree of confidence. I shared those trade ideas pre-breakout, and boom, boom, boom. And these are just massive. These are triple-digit gains. And again, the takeaway here is the comments have gone dead in the last few days. There's like 0 comments in the last few posts, which means people pretty much given up. And I think that's because most people are just trading the stock market. We've had just tremendous success on the long individual stock, long trade ideas. I've been bottom picking, getting a lot of stocks at the lows, including not limited that BYND lately. Those are bottom picking stocks and just vastly outperforming what the market's doing. That's where the money's to be made. I've told you before, I'm not chasing the AI bubble. NVIDIA can go to the moon and back. I'm gonna wait for that drop. I'm not gonna chase it here. It's just not my style. So I'll make money, and I'm outperforming NVIDIA by a huge amount. NVIDIA is going nowhere. But it's on individual stocks with the most bullish setups, typically blue chips to support, or other situations like the Beyond Meat, which was a unique overdone drop based on the news. So, all right, guys, that's it. So, boom, boom, boom. Look at these targets. What's that potential if hit? Let's just measure it out here for kicks and giggles. That's my line right there. Going to be about 100, and if that maximum target, which is just where the VIX went to before, going to be about close to 200% run, 180 something percent if it gets there. So again, I'll leave it here. I'll quit beating a dead horse. The takeaway is everything is setting up for a potential explosive move. And I think this market, let me correct myself. I know this market is rife with complacency and the belief that it is bulletproof right now. And that's where these moves come from. It's a lopsided, overly bullish market. Maybe a blow off top is in the works. Maybe it's coming. I don't know. I just know that I've seen similar periods where everyone thinks that's what it's going to do, and everyone's outright bullish and don't care about the government shutdown and how long. Believe me, this thing could easily break records for how the length I think this one will go. We all know, it's the dynamics. At no point in history, at least in my life, have I seen such polarization between the two parties. I think most people will agree on that. So to think that this thing is going to be kumbaya and, everything's good in a day or two, maybe, but I doubt it. And so we'll see, if the market starts to care when we go into week 2 of the shutdown. All right. So either way, that's it. So if you get these sell signals that I'm talking about, the breaks of the support levels in QQQ, the breakouts in the VIX, if you wait, sometimes you wait just a few days, you've missed at least an objective entry. There might be more meat on the bone, but then what happens is, here's where people want to buy. This is from my experience. They don't want to buy at support or on the breakout. They want to buy right here when they see the VIX start to rocket up. So then what happens? They buy UVXY or one of those leverage ETFs, and it does this. And they lose their ass. And then they stop out, and then it does this. And then they're like, shoot, I should have stuck with it. And they start buying here. And then by that time, the thing about the VIX, like I always say, it's just like short seller. Being a short seller, it's great, but you've got to be 10 times Johnny on the spot. Your timing has to be much better than a long side only trader or bull, because stocks go up most of the time. Shorting's extremely profitable because stocks fall much faster than they rise. And the VIX is just a reflection of the stock market correction. But if you stay too late to the party by even a day or two, you've missed almost all of, you're wiped out or given back almost all of your gains. So I've told you before, I will typically close my VIX longs out shortly before I close my equity, shortly before I see the bottom and my near-term targets are being hit on a correction. So I just want to throw that out there. But likewise, confidence is high enough, I start building position early, and I think that's the case right now. And then I showed you VIXY. Oh, no, the VIX, the actual VIX, spot VIX index. Again, making these, putting in these series, divergent low, divergent low, divergent low, pop after the divergent low, pop after that divergent low. Actually, that was the final pop, and pop up, and then boom. All right. Last but not least, somebody asked me about the grains and wheat and what do I use charting wise. Wheat just keeps going low. Yeah, the wheat, these grains, they just keep setting up. They set these little divergent lows. They start to pop. It's basing. Let me just show you what I do. For charting on the, I like futures, ZW are the futures for wheat. Hold on. So right here, this is the current contract, which is the December contract, right? I'll use this on, and I'm answering a question that was put to me. This is what I'm doing, and I'll wrap this video up. This is what I trade personally, and this is what I'll use on typically an hourly chart to get in, get out. You can see this is the big level, about 534.5, that we will finally run, I think, once that's taken out. It keeps making these marginal new and still divergent lows. And then a longer term, and this is again a proxy. If you trade ETFs, ETNs, it's an ETN technically, not an ETF. So you're going to get the K1 and all that good stuff. It kind of sucks, but and then longer term, I'll use this. Let's change pages. $ wheat. This is what Stock Charts calls it. They put a $ in front of it. It's a continuous contract. And these are my long-term charts. So this is a weekly chart with 25 years of price history on wheat. And again, this is a case I've been making for probably going on a year now, that this is my primary bull market uptrend line. So, and I started highlighting it and highlighting it as a bottoming play, long-term play here. And so far, it's still on that trend line. We had another hit recently. And I've been saying it's got to take out the downtrend line and then it'll run. Very constructive chart, no different. And I was highlighting it back here at the time. We had a 212% runoff there, but it has fits and starts just like it's doing now. This one was making higher highs and then finally took off 217%. It's not marked up, but I'm marking it for you right now. Divergent low, aka positive or bullish divergence. I just marked it for you here. Let me do it again. That was a divergent low back in 2020. Wasn't running the site then, so I'm not going to tell you I told you to buy it then, but it was followed by ultimately a 380% run. This is trend trading right here. And so this trade that I've been highlighting, looking for a potential bottom, this is the long-term multi-decade secular uptrend line in wheat. And so that's it. Now, one of these little 60-minute divergent lows will probably do the trick. Now, if it starts falling below there, I'm going to show you one other chart I have. It's the same chart. I just have what I call a BOD, or benefit of the doubt trend line on it. It's over here. Where did I put it? Bear with me. There it is. 30-year weekly. Okay, so you can see here I have two parallel trend lines that kind of define that trend. Starting off the 2000, same lows right there, the 2000 lows. But again, to answer your question, this is what I'll use for longer term, because what they do on this is they're splicing together the contracts. When you look at ZW, the regular futures, you got to trade whatever month you're trading, because it's going to, when they start to come to the roll date, you can still be in the Decembers, but then they're going to roll out the next quarterly. Some futures, a lot of grains are quarterly contracts, and they're going to have completely different price levels. So that's what the continuous does. It splices together. And so hopefully that answers your question. Long term, I'm going to use the continuous here on this charting platform. And then shorter term, I'm going to use the actual month's contract that we're in. And again, so you can see if we happen to take out, why do I have a BOD on this one? Why do I have two trend lines that are parallel? Well, this captures all these little reaction lows through there. One right there, I don't know if you can see it. So yeah, I could see another little drop there, and it wouldn't change my longer term outlook if it goes much below that BOD, or benefit of the doubt contract trend line. But this is the one I've been working. This is my primary trend line here, and I think we'll probably reverse. Another way to say it, guys, is, if you're waiting for a pullback here because that's a secondary lower trend line, but they buy it off this one, then you're going to miss the move, and you could miss out on the next, triple digit gain in wheat. So I'm going to stop it here. Hopefully that explains or answers the question. If it doesn't, just reply to me, and I'll give you some more clarification on the different charts I use for the various commodities. Okay, guys, let's wrap it up here. Let's see how we finish the day and the week, really. Remember, the shutdown's in play. It hasn't rattled. In fact, we've seen the opposite effect. Markets are rallying. They're buying. It wasn't much of a dip. Again, we closed, yesterday was, first day of the shutdown, and the markets closed green. So I don't know what to tell you on that. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.